Now, what we're seeing here is basically gold has had a huge run up from essentially the 2075 break to a high of 2024 and a quarter. And now it's been consolidating. So much like Bitcoin, you could make a case here that it's digesting that bigger move. Now, net, you still have to look at the factors here. And this is going away from the charts, but to the fundamentals where, we know the Fed at some point is going to lower rates. We know the government is not going to get their spending under control. And if they did, it would cause a massive, probably depression in the country, unfortunately. And so all of these factors mean that more dollars will be available, and therefore gold ultimately goes higher. Now, does that mean we can't correct back down and maybe pull back to 2,200? I still think that's possibly in the cards. I will be a buyer at 2,200 all the way down to 21. But ultimately, I think we're still going to 2,500 and even beyond.
Gold prices surged to a three-week high of $2,390 on Wednesday, following the release of U.S. Bureau of Labor Statistics data indicating a slowdown in inflation, thus increasing the likelihood of a Federal Reserve rate cut in 2024. Despite short-term fluctuations, Gareth Soloway, chief market strategist at verifiedinvesting.com, remains optimistic about gold's long-term trajectory. He attributes this positivity to potential Federal Reserve rate cuts and ongoing government spending, which he believes will propel gold prices upward. The recently released U.S. Consumer Price Index report for April, showing a 0.3% increase compared to the consensus forecast of 0.4%, aligns with the views of monetary policy doves advocating for early interest rate cuts by the Federal Reserve. This stance is considered bullish for precious metals due to anticipated consumer and commercial demand increases. In the short term, Gareth adopts a neutral to bearish stance on gold, foreseeing a potential dip to around $2,200. However, he maintains a bullish outlook on gold's mid to long-term prospects. Despite a near one-month high, gold prices retreated on Thursday amid a slight uptick in the dollar and cautious comments from a Federal Reserve official, tempering investor optimism. Gareth delves into chart patterns and trend lines, highlighting potential support levels for gold. Despite short-term uncertainties, he retains a bullish stance on gold as a trader and holder of physical gold assets. The World Bank's Precious Metals Price Index surged 9% in April 2024, continuing its upward trajectory from the first quarter. Gold reached a new nominal record in April, while silver approached its early 2021 peak. Join us as we delve into Gareth Soloway's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Again, here was your previous breakout, and this is something when I came on with you at the start of the year, it was my call that we were going to see a big breakout on gold. We obviously got that in the last, really at the start of the year, we got the breakout. Now, what we're seeing here is basically gold has had a huge run up from essentially the 2075 break to a high of 24 and a quarter, and now it's been consolidating. So much like Bitcoin, you could make a case here that it's digesting that bigger move. Now, net, you still have to look at the factors here, and this is going away from the charts, but to the fundamentals where, we know the Fed at some point is going to lower rates. We know the government is not going to get their spending under control, and if they did, it would cause a massive, probably depression in the country, unfortunately. And so all of these factors mean that more dollars will be available, and therefore gold ultimately goes higher. Now, does that mean we can't correct back down and maybe pull back to 2,200? I still think that's possibly in the cards. I will be a buyer at 2,200 all the way down to 21. But ultimately, I think we're still going to 2,500 and even beyond. I still think by December of this year, we're above 2,500, or at least have pierced during the next 6 months or so. So the answer is I am actually short the GLD, so I do have a short position on that. We're basically flat on this trade at this point, but you're right. That is ultimately the call where you get these blow-off moves, and then you look for this consolidation phase. You make a little bit on the short side, and then I flip it back into a long. So for me, I just haven't flipped it yet. I'm still expecting maybe one more move down. If we look at this, you could almost make a case that it's forming exactly what Bitcoin's doing, right? I mean, if we just put a channel in like this, you can absolutely see that this would be almost identical, which is so crazy. I mean, I love how charts in different assets just replicate this stuff. But here's you could tell me this was Bitcoin's chart and I wouldn't know any different, right? In terms of the formation at that particular time. And just to refresh, we can go back to that Bitcoin chart and you can see big move up, and then we had the same sort of price action. So the essence of it is, in the short term, I am neutral, maybe even neutral to bearish on gold, but mid to long term, just like with Bitcoin, I would be on the bullish side. Here, if we go back to 2022, this high on the dollar connects through these highs. We hit it right here, pulled back, and then broke out, retraced, and this now becomes support. So it was resistance here, here, and all the way back. And what you're looking for is now for the US dollar to continue down until we get back to this trend line. So I would basically anticipate a move back down to 103 over the next week or two. And then once we get to 103, you start getting some serious support on the US dollar. So I still think, yeah, I still think we got downside to go here. And I can even extend these lines out a little bit more. And what we can see is eventually this upsloping line will meet this one, and this will be some epic, epic support. But I still think the dollar has further downside to go over the next week or two. So obviously gold, that's been my most bullish one. That's the one that I favored. That's the one that I have. I have a lot of physical gold, etc., and longer term gold holdings.
Gareth Soloway anticipates that the Federal Reserve will implement interest rate cuts in September, citing economic indicators pointing to a slowdown in consumer spending and overall economic growth. Investor sentiment reflects optimism regarding the Federal Reserve's intentions, with a 72.6% probability of 2-quarter-point interest rate cuts anticipated for this year, commencing as early as September. Market focus will also be on statements from various Federal Reserve officials scheduled throughout the day, including presidents from different branches and the vice chair for supervision. Traders increasingly believe that the U.S. Federal Reserve may initiate interest rate reductions as soon as September, particularly following cooler-than-expected inflation data in April. Soloway highlights several economic indicators, such as the ISM Services Index, GDP growth, and non-farm payrolls, signaling a potential recession by the year's end. Additionally, rising unemployment claims further underscore the possibility of economic contraction. The deteriorating condition of the labor market also reinforces recession forecasts by seasoned forecaster Danielle DiMartino Booth, who told Bloomberg on Monday that the U.S. is already experiencing a downturn. This assessment is based on an indicator tracking unemployment over 12 months. Let's get back to the interview.
A couple days ago, we got the PPI data that came out hotter than expected. But the key in that report was that they revised last month's PPI to a negative 0.1%. And so, again, the psychology of that report, basically what that did was it made everyone assume that the report we got yesterday on PPI would be revised down next month. So that wasn't a huge negative. And PPI, in all fairness, is not as important as CPI data, which is what we got this morning. And that came in slightly better. Month over month, I think it was expected to be 0.4%. It came in at 0.3. Year over year came in at expectations. And the other thing to keep in mind is that psychologically, we had been, as an investing class, as everyone is investors, we had been conditioned to assume it was going to be a hotter number because the last 3 months were hotter than expected. So the mere fact that this report came in line or slightly better is basically a sigh of relief, if you will. And that allowed the markets to have this relief rally today. So the thing is, it's all about conditioning, right? Just a couple weeks ago, we were all wondering, is the Fed going to have to raise interest rates? And this report, you're right, we're still in that 3 to 4% inflation year over year zone. But at the same time, people are just relieved it is not going higher at this point. And that's basically throwing the market or investors a bone at this point and just saying, hey, listen, at least it wasn't worse than expected. And that's enough in this environment where the meme stocks are going nuts and everyone is all about risk on. S&P new all-time high, NASDAQ new all-time high. It's enough to kind of keep the bullish sentiment going, especially after Jerome Powell's comments yesterday, where he basically said, hey, no more rate cuts, or I should say no more rate hikes. Yes, we're not going to cut anytime soon, but later this year we will. And again, that's what the market wants to hear. Any positivity, anything that's not a negative is taken as a positive right now. So I do think they cut in September. I do think by September, we fully see a pretty significant slowdown. And I think one of the things to keep in mind, and I hope investors are kind of monitoring this, but I mean, think about Starbucks earnings, DoorDash earnings, Disney earnings. I mean, you could go on and on the list this past earnings season of consumer-led stocks that, again, require consumers to spend money. They all saw negative earnings, or at least the guidance was very, very weak. And the stocks took huge hits. I mean, Starbucks was down one of the biggest moves, as was Disney, that I've ever seen personally in my trading career. And so these are signs that the consumer, which is the backbone of the U.S. economy, is finally starting to kind of stall out. And that will slow the U.S. economy into recession by late this year. So ISM Services is a big one. That's gone below 50. And again, anything below 50 is a contraction. I'm looking at the slowdown in GDP. GDP GDP was less than expected recently. Non-farm payrolls less than expected. And I think the big one that I'll be watching Thursday morning is the initial claims report. Last week, we saw the highest level of people filing for unemployment at 231,000 since August of 2023. If that does not come back to 220 or below, I think you have a new trend here of people filing for unemployment and more people being laid off. And that will signal also a recession down the line. Remember, the economy moves slowly, so it's not going to be instantaneous, but I do think by end of year, we probably are in recession. Well, I think it just comes down to inflation, right? I mean, you look at the cost of car insurance, the cost of rent, the cost of food, the cost of energy. I mean, all of these factors are just at this point weighing down the consumer to where even though jobs have seen wage gains, right, where people are making more money, it's not overcompensating. In fact, it's a deficit from what they're paying. And it's incredible to think about. I mean, just to put this in perspective, just recently, Boston Market filed for bankruptcy, as well as we've seen, I actually just read last night that Red Lobster's looking to file for bankruptcy possibly by the end of this month. TGI Fridays is closing locations. We're seeing all of these kind of fast casual dining restaurants starting to cut back locations or going out of business. And the key here is that it's expensive. I mean, you go out to these places with a family of four, and you're talking well over $100, and that again is unsustainable for a consumer that is strapped paying rent, mortgage rates at this point, and all these other costs. And so it's almost like death by a thousand cuts, to be honest, for the consumer. And finally, the consumer who has run up $1.1 trillion in debt, and then phantom debt of $700 billion by buy now, pay later. At some point, that's unmanageable, right? You just can't do it and just continue to pay these bills. And I do expect default rates to rise on credit cards pretty substantially over the next 6 to 12 months as well.
Gold prices surged to a 3-week high, fueled by indications of a possible Federal Reserve rate cut in 2024. Despite short-term fluctuations, optimism prevails for gold's long-term prospects, supported by potential rate cuts and ongoing government spending. The slight uptick in inflation aligns with views advocating for early rate cuts, while economic indicators hint at a looming recession. What factors influence gold prices in the near term, and how do you perceive the potential impact of rate cuts on the broader economy? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.